Welcome back and welcome to Homes Today. This will be headed by a sharp and a clever realtor by the name of Miss Audrey Forshey, who is from Remax Realty. Audrey is also an advisor. Today, Audrey has alongside her a financial advisor by the name of Michael Brazovac. This morning, these two professionals will talk to us about life insurance. Let's take a close look.
Hi friends, thank you for joining us again today. My name is Audrey Forshey and I'm a Remax agent in Montgomery County, Maryland. Today I have, my guest is Michael Brazovac, who is a financial advisor in the Washington, D.C. metropolitan area. Thank you for being with me today,
Thank you for having
Michael. Today we're going to talk about life insurance, and we're going to talk about it in a way that maybe it deals with your home, but we're going to talk about it in a general case of different kinds of life insurances and maybe who's the best candidate for life insurance and whether or not maybe you should consider adding that to your financial portfolio. So we have life insurance. We've all heard of life insurances.
Yeah.
Tell us what the different kinds of life insurances are that people can have.
Okay, there's two types. You have a permanent policy or you have a term policy.
Okay.
And then within those policies, there's some hybrid policies as well.
Okay.
Some that could add long-term care to it, other policies that would have some other care benefits associated with it.
Okay.
But in just general terms, you have two types of policies.
Okay. So a term life insurance policy would then be one that I would pay for a certain amount of time, and then if something happened to me, then whoever my beneficiary was, they would get a lump sum. Is that how that works? You, like, let's just say you have, I don't know, $500,000 worth of life insurance, and then is it paid all at one time to my beneficiary if something happens to me?
Yes.
Okay.
So, and that's what you generally will see with a lot of first-time home buyers, right?
Okay.
So a married couple with their first home have
Right.
a mortgage.
Right.
Okay, and they need to cover that mortgage if something happens to one of the breadwinners.
Okay.
Or if something happens to the other spouse.
Okay.
Okay, where's that money going to come from?
All
And
right.
so term life insurance is the cheapest way to cover that.
Okay.
And as the name suggests, you buy it for a term, 10, 15, 20, 30 years.
Okay.
And that's generally the cheapest way to do it.
Okay.
Okay.
So just for example, when my husband and I first got married, we had our house that we purchased, and that we both needed our incomes to make our mortgage payment
correct.
and to be there and live in the home. So in the event that something happened to one of us, we had a policy so that the other one could stay in the home until we maybe decided what we would do if we moved or stayed there or pay off the mortgage. So ours was that we would pay off the mortgage. So that makes me think about the kind of insurance mail that you get, like from your mortgage company. Have you ever gotten the flyers that say get life insurance for your mortgage? I think regular life insurance would be better than having that kind of mortgage insurance. Is that right?
Yeah, everybody's needs different. Generally,
Right.
you have to look at life insurance. There's three reasons for life insurance. The main reason is replacement of lost income.
Okay.
So the second reason could be for estate planning purposes.
Okay.
And the third reason could be for investment purposes.
Okay.
But the general use of life insurance is to protect against the untimely death of a spouse who's bringing income into the family.
Okay.
Okay. And so when you see the advertisements for mortgage companies that, you know, add a certain fee monthly and say that we'll pay off the mortgage, that's okay. Okay.
Okay.
A lot of times you don't have to qualify for those benefits.
Okay.
But understand that there's much more to just the mortgage being paid off. So go back to your situation with you and your husband. If one of you were to pass away early,
Right.
okay, there's more expenses than just the mortgage.
Right.
There's the upkeep to the house.
Right.
There's the utilities. There's the lost income for saving for retirement.
Right.
So generally, that's going to be a much bigger sum than just paying off the mortgage.
Okay, so then the one that would come from your mortgage company to add to your payment potentially would just pay off the mortgage. It wouldn't give you any cash to use for other expenses.
Exactly.
Okay,
And,
all right.
and keep in mind, if you have a 30-year mortgage,
Okay.
for every year that you're paying down that mortgage, the principal balance is going down.
Okay, that's right. Oh, that's right. Okay. So then when I'm going to apply for life insurance, does it matter like how old I am, how I guess I'm assuming that the older you are, the more expensive it is. What's all involved in getting life insurance? I guess they call it being rated. Is that right?
That is correct.
Okay.
So, and again, it goes back to the two different types of policies you have.
Okay.
So for term,
Okay.
the underwriting, and that's what the process is that you go through, is underwriting,
Okay.
may be easier if you're only getting a 10-year term.
Okay.
Because the insurance company is, so to speak, on the hook for 10 years.
Okay.
You're going to pay them premiums each year. Let's say that you're going to have a $500,000 face value.
Okay.
At the end of 10 years, they don't owe you any more money. That policy has now lapsed. It has expired.
Okay.
So they may only look at your medical history and determine their risk in the next 10 years. Where a permanent policy, something that you carry for the rest of your life, and they will pay out when you pass away, they're going to look at how healthy you are or how not healthy you are, right? At their risk level, meaning that if you have some markers or you have some pre-existing conditions, then for them, they may have to pay that policy out earlier. They're hoping that you're going to live for a long time and continue paying premiums. But if you pass away very early, they have to pay that out to your beneficiary. So that policy may get more expensive.
And what are the other kinds that aren't term? What's the other kind? It's called whole life or something like that?
Yeah, there are variations. So you have whole life, okay? You have variable life. You have indexed life, okay? Variable universal life. So there's all types of different policies out there. Each one has specific functions to it. The best thing to do is talk with an insurance agent or talk with your agent to identify what your need is. You know, what are you looking to do? Go ahead.
No, go ahead.
Well, I was going to say probably one of the most important things that people forget about, especially families just starting out, they bought their first house or thinking about having children, is the estate planning process. And part of that is getting life insurance. But the problem is that the incomes, you know, they're probably on a tight budget, especially if they're buying their first house. You know? So term life insurance is probably the most inexpensive way to cover the unlikely event and to have that peace of mind without spending a lot of money.
That's probably the best way to go. And I
think
I think that's the most popular, and I think that that's what we started out with also. So in terms of the whole and the permanent policy, what are some of the other differences between them once a person passes away and they're paid out? What happens? How are they different?
Well, specifically what you asked was between whole and permanent. And whole is permanent.
Okay. I'm sorry.
That's okay. So in term, and that's a good question because a lot of people don't understand this. So in term policy, you know, a lot of people go towards that because it's the cheapest. And it covers them for that peace of mind in case something happens. The problem is that after that 20 or 30-year term expires or whatever they signed up for and they stop paying their premiums, they have no more life insurance. So if they decide to get more life insurance, they may not be insurable at that time because there may be a whole new medical history. So that's something they need to think about. The other difference is there's generally what they call cash value in a permanent policy.
I've heard of that.
Yeah, so when you're paying money into that policy, you're putting in more money than what's covered for just your life as far as the cost of your life insurance. And that life insurance goes up every year as you get older, of course. But the additional money on top of that cost gets invested. So if it's a whole life policy, then that insurance company may pay dividends to you, and they invest that money. If it's a variable policy, then it may be in the stock market, it may be an annuity. And you may have certain different parameters for the investment. So the goal is, of course, to grow that cash value. Now, the important thing with the cash value is on a permanent policy is that in later years, you could use that money, take a loan against it, put somebody through college with it, or take the money out if you get older and decide based on your financial net worth that you don't need life insurance anymore.
So as my husband and I, as we get older and we look at our own situation, we may or may not want life insurance anymore. So if we would look at our situation, and because we've had term life insurance, that means that we've paid all that insurance money, and because, you know, we're still both here, knock on wood, because you know you want the insurance, to make sure that everybody's okay. But so that just goes away, and there's no kind of recuperation for us on that money. That just goes away, and then you've said that the whole life would have investments and all that sort of stuff. So once our term is over, we may not qualify for more, but we might not need more insurance. Is that right? We might need something different. So then what are your suggestions maybe in terms of that?
Well, so every few years you should always look at your needs, right? So and the best way to do that is look at your cash flow analysis.
Okay.
And then look at your assets. So hopefully every year your assets are growing. And those assets could be your 401k, your IRA, the equity in your home.
Right.
Those are all going to be assets.
Okay.
Specifically your retirement and your taxable accounts are what you're going to turn into a retirement paycheck when you decide to retire.
Right.
So that's an important piece of the picture, because to determine if you still need life insurance, you have to look at, once you retire, do you have enough assets to live out your life?
Right.
Okay. And if the answer is no, then there's probably the need still for life insurance.
Okay.
Because if your spouse or you are not contributing to your retirement accounts, or you have a loss of income early before you hit retirement,
Right.
then you're probably going to need to replace that, and that's where the life insurance would come in.
Okay. And just, we've talked about different kinds of the life insurances. Is there a person that, you know, you said the young people, and it's cheaper to do the term life insurance rather than the permanent life insurance. Who is a candidate for the whole life insurance or the permanent life insurance? Why wouldn't they just want term life insurance?
That's a great question.
Okay.
So, because the permanent one will stay with them forever. And so they may decide that, you know, I'm young, I'm healthy, okay, so let me get this insurance now while it's cheap.
Okay.
Now it will be more expensive than term, but it will still be cheaper than getting it 20 years down the road.
Okay.
And the important part of that is, as they're contributing to that life insurance policy, they're putting money into an investment, whether it's a whole life policy or whether it's a variable policy. They're putting money towards that investment, and it's growing tax-free or tax-deferred, depending on how you use that policy. And so their goal is to build, as an investment account, more money in that cash value. Okay. And some people will take that cash value and borrow against it in later years.
Okay. And can if you pay a penalty, like just for an example, if I had an IRA and I wanted to, but I'm not going to use the IRA, but I have a permanent life insurance and I need to borrow money. Are there penalties or anything? Do you have to repay back into the whole life account and all that sort of stuff?
Yeah, and so what's important to know is, you know, wherever you have your insurance policy, make sure you look at all the specifics with your insurance agent. So you can borrow against that policy, but the cost of your insurance continues every single year. You have to pay the life insurance part of that. And so if you borrow too much money from your policy and you don't pay it back, and you're required to pay it back, and you don't pay it back, the policy lapses. And when the policy lapses, that may be a taxable event to you. And now you don't have any life insurance. So the important thing is that when you do look at borrowing maybe some cash value from your policy, talk with your financial professional. And look at the best ways of doing this, and make sure that you have the means to pay it back.
All right, so there you have it. Michael Brezovic has come and talked to us today about life insurance. There are the different kinds. I hope that you got some good information from this. Maybe if you're younger and you're just starting out, just to protect your family and yourself, you'd like some term life insurance. And maybe if you're able to have a whole life or permanent policy, maybe you should look at that. We encourage you to contact your insurance agent or your financial advisor to maybe see if this is a right vehicle for you and your family to help you keep your finances together. Thank you very much.